Welcome to episode 1 of the MPowered Finance podcast with your host, Sid Misra, certified financial planner based out of northern New Jersey. Thank you all for tuning in for the inaugural episode of this podcast that I hope to be releasing every 2 weeks. Uh, I wanted to just talk about GameStop because that is what everyone's talking about. That's what I've gotten a ton of questions on from family and friends, and I just thought that it would be good to explain what's going on in the market, explain why it's happening, and kind of explain where I see this going, because it's going to be very interesting. So, for everyone that's obviously been following along, the big news is GameStop, this brick and mortar location to sell video games and also go and trade old ones in. The stock has jumped an incredible percent, 1,000%, whatever a number it is. It used to be trading below 20, and now it's trading above 300. And it's interesting because the stock itself is not good. The business is not good, right? And so, why is all this happening? And so, essentially, we have to understand, the forces that are in play with GameStop and what's actually going on in the market. So, just a quick economics lesson or finance lesson. When you own stock, you own a piece of a company. And so you own that stock because you believe that that company's business is going to do well. They're going to be profitable. They'll make money, and the stock will be worth more later on. And you can turn around and sell it for a profit. So you buy a stock for, let's say, $10 a share. The business does well, and it's now $20 a share. You can turn around and sell it and make a profit. And that's called going long. You're waiting for the stock to go up. The opposite end of that is a short position. And a short position is essentially a bet against that stock or company. And Wall Street hedge funds are notorious for making these bets because they'll look at a business and say, just like GameStop, right? It's a brick and mortar business that's selling video games where people can just buy them via Amazon or some online company, or they can download it directly to their PS5 or their Xbox. And so there's really no place for a business like that. They're losing money every year. And so Wall Street says, you know what, instead of just focusing on the companies that do well, we can bet against a company that's not going to do well, and that we think the stock price will go down, and we can make money off of that. And so when you're long a company, when you're betting and you wanting it to go up, you own the share and you can turn around and sell it later. When you're shorting a company, right, betting against it, you're borrowing shares. You don't actually own them. So what happens is these hedge funds go out and they borrow shares of GameStop from someone who has excess shares, right? There are many, many shares out there, and they will turn around and immediately sell them in the market for whatever that current price is. So let's say it's $10 in the market. They borrow shares, turn around and sell it for $10. Their bet is that GameStop's share price will go down, because what will happen is if the price goes down, they will immediately buy back those shares that they borrowed, right? And they've made money on the difference. They sold it for 10, and let's say they're buying back for 5. They've made a $5 difference, and now they have to go down. Now they will go back and return those shares to whoever they borrowed them from, right? So they made a $5 profit. They give a little bit of interest to the borrower or whoever they borrowed from, as interest, but they've walked away with a profit because the share price went down, right? So you borrow shares, you turn around and sell it, make that money. When the price goes down, you buy it for a discount, and then give back the shares and keep the profit. Now, what ends up happening on the other side is, if the share price ends up going up, right? So you borrow shares, you immediately turn around and sell it on the market for, let's say, $10. If that price goes up to 20, you're on the hook to buy those shares because you made a promise to that person you borrowed from that, hey, I'm going to borrow these shares. I'll give them back to you by a certain date or within a certain amount of time. So the price goes up, and you're like, oh boy, okay, so now I have to go back out and buy them at, let's say, $20 a share, or maybe $30 a share, right? So now you're losing money on that. And where your benefit could be limited, right? Because there's no stock price that can go below zero. So you have a limited upside gain as a short seller. There's no real theoretical limit to how high a stock price can go. So you can end up losing. I mean, there's no limit to how much money you can lose on a short sale, which is why they're very, very dangerous. And really only hedge funds and people who really, really know what they're doing do short selling. So this is kind of what's happened here is hedge funds have made a bet against GameStop, right, where they've borrowed those shares, they've sold it in the market, and then they're waiting for the price to go down so that they can rebuy it and make money off the difference. Now here's where the power of the internet comes in. Essentially, what's happened is someone on Reddit, which is a website that aggregates and pulls things from all over the internet together, and it basically gives a forum for people to talk and comment on articles or videos, or in this case, for the Wall Street subreddit, for the subreddit Wall Street Bets, talk about different stocks and trading and all that. And because of apps like Robinhood, and on just the advent of that technology, it's more readily available to people. Last year, 2020, over 10 million new brokerage accounts. So Robinhood's a brokerage, and you can open up a brokerage account there. Over 10 million new accounts were opened up around the U.S. So that's Robinhood and all the other platforms there. So what someone on Reddit figured out, which is really interesting, is they saw how many people have shorted a particular stock. They saw that GameStop stock was shorted 149%. So technically, there were more shares shorted than there actually were shares that existed. And so someone on Reddit had the idea of, well, these hedge funds have really overextended themselves, or have really put themselves in a position where they bet against GameStop. If we get enough people to buy the shares of GameStop and buy the stock, the price will go up, and we're going to actually hurt the hedge funds. We're going to squeeze them. We can make money, but more importantly, for a lot of people, we can hurt the hedge funds. And that's what they ended up doing. And so, they effectively crowdsourced an investment strategy of just getting into GameStop to drive the price up artificially, because there's no business reason why the stock should be up as high as it was. I mean, I think it hit like 500 last week, and then recently was at 300. And while I'm recording this on Sunday, it was at 300. So, or above 300. There's no reason why that price should be there. The business does not give you any evidence that the price should be there. So this is all basically just done by people flooding the market with demand, and there being less supply, and now they're holding on to these shares. So, a lot of people are asking, why are they doing this? Aside from kind of making money, which you will, the value of the shares has gone up, right? 300 and whatever dollars a share. If you sold it, you'd made money. But really, why are people doing it? And I think it's a very interesting point in history that we'll, I think, probably look back on as the start of just kind of this disruption in how we do finance. But one, I just think people are bored, right? The pandemic, we can't really do much. We're waiting for the vaccine to come out, and people are bored. I remember last year when the pandemic started and a lot of sports were canceled, everyone was getting on these apps. Everyone was getting on Robinhood. Dave Portnoy, the founder of Barstool, was talking about investing because he likes to gamble and he wants to do all those things. So people are bored and they have nothing better to do. So they want to have some fun, and I think for them, a lot of them, it is fun. I think the second reason is just there's a lot of people doing it. Again, there's access, right? I mentioned before, 10 million new brokerage accounts were open in 2020. It's the most ever. I mean, that's basically just a crazy number. So now all these people have access to trading, and they want a piece of the action, right? And again, I think the biggest thing that I see is just it's a big fu to the system. Um, they have this disdain for suits and the people who they feel are running the country and play by different rules. If you see and you read some of the posts on Reddit, a lot of these people were, in high school when the 2008 2009 financial crisis happened, and they saw their families lose their jobs, their houses. Many families have not had steady income or steady jobs since then, and they've seen, they saw Wall Street at that time get a bailout. They saw Wall Street at that time, no one go to jail, and then they were left just like with nothing, right? There was no bailout for Main Street, and so a lot of people saw that. They saw the amount of money that was made since then, in the markets, while the economy has done better, but still a lot of people are struggling. And then especially with COVID, where a lot of people are forced to be at home now, they can't make money, and yet the stock market's at all-time highs. And so they look at this as an opportunity to exact some revenge, an opportunity to do something anything to get some sort of revenge on these people. And I think it's very interesting, why they're doing it. It's why I think a lot of them are just saying we don't care about losing money. There are those who have put in a few $100, a few $1,000, with the understanding that, like, yeah, if it goes down to zero, I don't care, as long as I can effectively bleed out a hedge fund, if I can effectively cost them money and screw with them a little bit. They lost more money and their families suffered more than what this loss would be. So I don't think that they really care in that regard. So what was the reaction? I mean, obviously, it's all people are talking about in the news. It's all Wall Street, CNBC, Fox Business, Wall Street Journal. Everyone's talking about, and it's bringing up some interesting points because, last week we saw Robinhood halting trades, some other platforms halting trades, for GameStop specifically, for some other securities, I believe, but for GameStop specifically. And then we're finding out that, some of these hedge funds are able to get out of their positions or cancel their shorts while other people are being effectively frozen out of the market. And so, in a country that screams about capitalism all the time and thinks about it as a religion, really, in my opinion. And I have no problem with capitalism. I just think that you're seeing two sides to it, right? You're seeing capitalism for everyone when Wall Street's making a ton of money, and then you're seeing them wanting some sort of regulation or help when the tables are turned and they're losing money because people are standing up to them. And so this doesn't look like a free market. This doesn't look like capitalism. I hope that we find out what's going on. It's just funny to see like AOC and Ted Cruz agreeing on this, politics aside, and a lot of people are coming together and saying like this is not right. So yeah, Robin Hood not acting like Robin Hood and effectively stealing from the poor and giving to the rich. But I think too, the larger piece of this, and the thing that I keep thinking about, is the future of finance. These people want to have a decentralized way of doing things. They don't want to play by the rules anymore. They don't want to have markets that are only open to between 9:30 a.m. and 4 p.m. On non-US holiday days, right? And closed on the weekends. They want access to the market 24/7, 365 with no rules, which it's dangerous, but excuse me, at the end of the day, it's dangerous, but at the end of the day, it's the truest form of a free market. I don't know if I would be investing my money there or my clients' money there, but That's what people want, and I think that's where it's going. You're looking at decentralized currencies. You're looking at the talk of decentralized markets, like I was saying. You're talking about people effectively coming together and getting 1,000, 10,000 people together to start their own hedge fund to throw their weight around. And so the internet has really just leveled the playing field. I think the average Joe in Main Street understands that if they want the same power, they're going to have to do it together, obviously. And I think people are willing to do that for the right reasons. And so Mark Cuban even said, it'd be interesting companies that may not have a shot otherwise, that are, that may be socially helping people and helping the environment, whatever, that may not otherwise get funding. You could see this kind of crowdsourcing of private equity or something like that. So it's going to be an interesting thing to see going forward. I'm super excited. I I'm excited to see what happens with GameStop, because at the end of the day, the music will stop eventually. It's going to end. There's just no way that's going to be sustained. And so, if that means that the price comes down and people lose money and hedge funds lose money, I mean, that's the risk you take, right? That's the risk you take when you buy and sell securities. You can lose money. And so I think that is important to remember. Someone's going to lose money. Someone's going to be left holding a bag of what at the end of all this. So I hope this first episode wasn't rambling too much. This is the first time I'm doing this. Be nice. Please subscribe. I appreciate the support, and look forward to doing the next one. Thank you.